This video is over dividends and other payouts. I'm your professor, Dr. Stephen Haggard. No discussion of capital structure would be complete without discussing payout policy. Why might this be? Well, payout policy is how the firm distributes cash to its shareholders. And we know that net income must flow to two places, dividends and addition to retained earnings. And so whatever we are not paying out to our shareholders gets reinvested into the firm and becomes addition to retained earnings or equity. And so over time, if we have a firm that's 50% debt, 50% equity, if they fund all new investments purely through these retained earnings, the percentage equity in their capital structure will go up over time. And so payout policy is one of the things we can use to help us maintain that constant debt to equity ratio that the target adjustment theory says we might prefer. And so today we're going to talk about dividends and other payouts. Let's talk about the different types of dividends. The ones that most people know about are called regular cash dividends. Regular because they happen over the same periodicity, and cash because they are paid in cash. Now, what is that periodicity or frequency? Typically, companies pay quarterly. Now, let's say very carefully here, companies do not have to pay dividends. But if they do pay dividends, they tend to pay quarterly. But there are some firms out there that pay on different frequencies. For example, there are some that pay twice per year rather than 4 times per year. And sometimes you'll find a firm pay an extra cash dividend. Let's say that the firm is the winner of a lawsuit over a patent, and they receive a huge settlement. The one-time funds may be distributed to the shareholders through an extra cash dividend. But the firm will make sure that the shareholders understand that this is not a regular cash dividend, because then the investors would expect that cash dividend going forward and they would not receive it. And the most extreme case of dividend that we see is the liquidating dividend. Let's assume that your company has been put together to serve a need for an Olympics game. After the Olympic Games are over, that firm no longer serves a purpose. And so the firm would sell all of its assets, pay off all of its liabilities, and then pay out the remaining money to its shareholders as a liquidating dividend. And then we have what are called stock dividends. And I don't think these things should be called dividends at all, because a real dividend, a regular cash dividend, or an extra cash dividend, or a liquidating dividend puts cash in your pocket. The stock dividend does no such thing. A stock dividend works like this. The company declares a 2% stock dividend for an owner of record on a given date. Well, that means if you own 100 shares afterwards you will own 102. Now you may think that sounds nice, except for one thing. We are dividing the same value of the equity over more shares. And so before and after, we should end up with exactly the same value of the shareholders' holdings. In fact, I would hazard a guess that the costs associated with the stock dividend would actually reduce the shareholders' value of their equity, because that money has to go outside of the company in order to print up new stock certificates and make all of these transactions. Then we have what's called the dividend in kind. Assume that you have a company that makes chewing gum. If they sent you a box of their newest chewing gum as a dividend, that would be called a dividend in kind. In other words, it's when the company sends you their product. Now, these are fairly rare, and there are many types of companies that you would see would be unable to do this. For example, what if a company were involved in the construction of fighter jets? Do you see Lockheed sending you an F-16 in the mail? I don't think so. Now, finally, we have a rather morbid example. Dundee Crematoria offering shareholders discounted cremations. I would think that your loved one would have to present both your death certificate and your stock certificate to Dundee in order to receive this deal. So what are the standard methods of the cash dividend? Let's talk about some vocabulary, the different ways that dividends can be expressed. You commonly hear people talk about the dividend per share, and that's the dollar amount of the dividend on a per share basis. And something that's not mentioned here on the slide is that this is in an annual basis. And so if they say they're going to pay a dividend of $1 per share for the year, then that means you will only receive 25 cents per quarter. And so you have to be careful there not to be thinking you're getting 4 times as much dividend as you actually are. And then we have the dividend yield, and that is where the dividend is expressed as a percentage of the market price. I have had students before who told me they were getting rich because what they were doing was buying these companies with these really high dividend yields. And I asked them, tell me the names of these companies. I said, let me tell you something. Before we even look them up, I can tell you something about them. Their stock price is way down compared to what it was very recently. And we would look them up, and sure enough, that was exactly the case. So you have to be careful when shopping around for firms with high dividend yields. If the firm consistently has a high dividend yield, then that's fine. But if it's only recently developed a high dividend yield, that means that the market has figured out the company is in trouble and has dropped the share price accordingly, but the company hasn't gotten around to cutting their dividend yet. Be assured that they will either be cutting that dividend or they will be going bankrupt. And then finally we talk about dividend payout, or the dividend payout ratio. And this is the dividend per share divided by the earnings per share. In other words, it's answering the question, what percentage of net income is being paid out to the shareholders as dividends? So what is the procedure for a cash dividend? First of all, let's talk about who declares the dividend. It's the board of directors of the firm, and the dividend must be declared by the board of directors of the firm before it can be paid. What if a firm has consistently paid $1 every quarter for as long as anyone can remember? Can you for sure tell me what the next dividend will be? No, because each quarter's dividend gets declared individually. And if the board for some reason can't meet to declare a dividend, then the dividend doesn't get paid. But usually boards find a way to get together, and they have the date upon which they declare the dividend. That's known as the declaration date. And this declaration will say something like this: the firm will be paying a dividend of 25 cents for the first quarter to any shareholder of record as of January 30th. Payment will be made on Monday, February 16th. And you say, great, all I have to do is buy these shares by January 29th and I'll get that dividend. But that would not be correct, because the SEC has a T+2 rule. What does that mean? It means that 2 days before the record date is something called the ex-dividend date. And that is the date at which the shares first trade without the dividend. In other words, if I buy them on the 28th, I don't get the dividend. Now here's a way to remember that. Ex-dividend means without dividend in the way that ex-wife means without wife. And so what day would you have to buy on in order to receive the dividend? Well, on January 27th, the stock would be said to be trading cum dividend. Cum is Latin for with. You may recognize it from such phrases as magna cum laude. So let's talk about what happens to the share price when the firm pays a dividend. Now we know that the dividend represents value leaving the firm, so the share price must drop. And if we lived in a world without taxes, it would fall by the amount of the dividend on the ex-dividend date, because after all, that's the first date on which the stock trades without benefit of that dividend. But taxes complicate this. Let's assume that the average tax rate of the shareholders was 15%, and they were paying 15% on these dividends. That means that on average, these dividends are only worth 85 cents to those investors. And what does that mean? It means that the share price will only drop by 85 cents on the day that it gets, or the stock goes ex-dividend. Now, a lot of times we actually see the percentage being lower than 15%. And there are a couple of reasons for this. Number one, pension funds do not pay taxes on dividends. And so there is a dividend group, a group of owners that pay no taxes whatsoever. Corporations can exclude at least 50% of the dividends they receive from their taxable income. And so you might think of them paying basically half the tax rate on their dividends. And so this drop tends not to be, or the tax portion tends not to be as great as you might think, and so the stock price drops fairly close to the amount of the dividend. When we talked about capital structure, we talked about the irrelevance of capital structure. Well, now let's talk about the irrelevance of dividend policy. In other words, maybe dividend policy doesn't matter. Investors do not need dividends to convert shares to cash. How could they make their own dividends? Well, they could sell shares. As a result, they will not pay higher prices for firms with higher dividends. In other words, dividends are not going to have an impact on the value of the firm, because investors can choose whatever income stream they prefer using homemade dividends. Now you may remember that we talked about homemade leverage when discussing capital structure irrelevancy. Well, now we're going to talk about the homemade dividend when discussing the irrelevance of dividend policy. Okay, let me give an example of homemade dividends. Bianchi Inc. is a $42 stock, and they're about to pay a $2 dividend. Now, given what we just talked about, we know that on the ex-dividend date, the stock price will drop to 40 if nothing else happens. Bob is an investor. He owns 80 shares, and he prefers a $3 dividend. Maybe Bob is a retiree with a gambling problem. We just don't know. But what's Bob's homemade dividend strategy? Well, he could sell 2 shares ex-dividend. And when he does, that's going to bring in 2 times 40, or $80, in addition to the 160 he's receiving as a cash dividend. And so his total cash will be 240 instead of the 160 from just the straight dividend. In other words, Bob can make his own dividends. Now, we've got to keep in mind, though, when this is all over with, that Bob has 2 fewer shares than before, and so his holdings are now worth 80 less than they would have been had he not created this homemade dividend. But the purpose of this example is to show that the total value of cash and stocks is the same either way. Whether Bob makes his extra dividend or doesn't, at the end he still has $3,360. So, dividend policy is irrelevant because Bob's wealth is not changed by either taking the dividend as offered or making his own. There's no way that Bob can make himself better, or there's no way the company can make Bob better off that Bob could not duplicate. So let's talk about dividends and investment policy. We know from corporate finance that the goal of financial management is to maximize shareholder wealth. And to do so means that we need to accept all positive NPV or net present value projects. What does that mean for dividends? It means that we should never forgo positive NPV projects to increase a dividend or to pay a dividend for the first time, because doing so actually hurts shareholder wealth. If we are able to invest that and get a better return from for our shareholders than they could get on their own, then we are better off investing that at the firm. And any positive NPV project meets that criteria. So recall that one of the underlying assumptions of the dividend relevance argument is that the investment of the policy is set ahead of time and is not altered by changes in dividend policy. In other words, we are not going to give up projects so we can continue paying dividends. Now let's talk about another way in which firms can return value to the shareholders. It's called the repurchase of stock. So instead of declaring cash dividends, the firms can rid themselves of excess cash through buying shares of their own stock. What do we mean by excess cash? Well, that's cash that is in excess of that necessary to fund the positive NPV projects of the firm and to run the normal operations of the firm. We call that free cash flow. And so that free cash flow should either be paid out as dividends or used to repurchase the stock. Recently, we've seen an upswing in the importance of share repurchasing as a way to distribute earnings to shareholders. Back in the old days, dividends were the primary means that companies used to give money back to the shareholders, but we've seen over time that while dividends have continued to grow, that buybacks have grown even more. In fact, what we have here is a graph of the quarterly variation in reported earnings, dividends, and buybacks. Remember that earnings is where this money is coming from. That's your top line. And earnings are more volatile or more variable than either buybacks or repurchases or dividends. But let's talk about these two things and their variability versus each other. Dividends are what we call sticky. Now, what does that mean? It means that managers are only going to increase dividends if they think the earnings of the firm have increased on a permanent basis. But what might they do if they were less sure? Well, then they could use that money to do a buyback instead of paying a dividend. And that way, if the new higher level of earnings was only temporary, all they would have to do is suspend the buybacks and they would not have to cut the dividends. So let's consider a firm that wishes to distribute $100,000 to its shareholders. In the beginning, we have $150,000 in cash, $850,000 in other assets, so the total value of the firm is $1 million. The firm has no debt and $1 million in equity. The shares outstanding is 100,000. And so we can find the price per share, or at least the book value per share, by dividing 1 million by 100,000 and see that it is $10 per share. So if they distribute 100,000 as a cash dividend, in the end, the balance sheet is going to look like this. Cash will be down by the 100,000. The other assets of the firm stay the same, and the new value of the firm will be 900,000. We still have no debt, and the firm is worth 900,000, means the equity must now be worth 900,000. In other words, the equity drops by the amount of the dividend. The shares outstanding 100,000. Now we've got 900,000 divided by 100,000. The price per share should be $9 per share. And that fits perfectly with what we discussed earlier. If the shares were originally $10 per share and you pay a $1 per share dividend in a world without taxes, your new share price would be $9. But what if instead they do the $100,000 stock repurchase? Well, then the balance sheet would look like this. They're going to use $100,000 of cash to buy back $100,000 of shares, and as a result, the total value of the equity will drop by $100,000, and so everything will look exactly as it did before so far as the balance sheet is concerned, except for one thing. The shares outstanding are now 90,000. Well, how do we know that? Well, 100,000 shares divided by $10 per share is 10,000 shares that have been repurchased. And so the shares outstanding will be 90,000 afterward. And so the price per share would be 900,000 divided by 90,000 is equal to $10. In other words, the stock price should not drop on a stock repurchase like it should on a dividend. Why? Because with the dividend, we are sending value out of the firm, but we are keeping the same number of shares. With the stock repurchase, we are sending value out of the firm, but we are also proportionally reducing the shares outstanding. And so a stock repurchase, at least from an accounting perspective, should have no impact on the share price whatsoever. So what kinds of things should you consider when choosing between dividends and share repurchases? What are these real-world considerations? Well, first of all, there's flexibility for shareholders. We're going to discuss clienteles, dividend clienteles. And there are groups of people, like my father, who like to get a check on a regular basis. Why would he want to get a check on a regular basis? Because he no longer works, and so he no longer has a paycheck. So it's important to him to get money on a regular basis from his investments. But as for me, I would prefer to keep all of my money in the company. I don't want a dividend. Why? Because I don't want to have to pay the taxes that go along with dividends. And so as a result, I would prefer a share repurchase. If the company decides to repurchase shares and I want money now, I can go ahead and sell my shares. But if I don't, then I just hold on to my shares and continue as I am. In other words, I have more flexibility with a share repurchase as a shareholder than I do as a dividend. There's no way for you to refuse a dividend. If they pay it, you're going to get it. Now, the share repurchase also keeps the stock price higher, and so that's good for insiders who hold stock options. So let's discuss shortly how stock options work. If the stock price is currently $20 per share, the board of directors might give the management the opportunity to buy shares at $25 per share 6 months from now. Now, when would that be useful? It's only useful if the stock price is up over $25. Let's say we have a choice between a dividend that would give us a stock price of 27 after the dividend, or a repurchase that would leave the stock price at 30. We can easily see that the management would prefer the repurchase because their profit on their stock options would be $5 instead of $2. 30 minus 25 instead of 27 minus 25. That's a substantial difference. And so what we've seen is, since stock options have become a popular form of compensation, share repurchases have risen alongside them. We also see that repurchases are an offset to dilutions. Anytime that we issue additional shares, such as those for stock options for executives, if we don't also at the same time buy back other shares, now we have a higher number of shares outstanding. And so the denominator of measures, like the earnings per share, will be larger, leading to lower EPS. And that will be seen as a negative. And so we end up with people wanting to keep the number of shares smaller to help prevent that dilution. Now, a good reason for a share repurchase would be if the management thought that the shares were undervalued. Remember, we said that if a firm is issuing equity, it sends the message that the firm's shares are overvalued. Well, what would the opposite signal be? If the firm is going to buy the shares back, that means that the company thinks the shares are worth more than the current market price. Now, many managers are wrong when they think this, but at least the firm managers do not believe the shares are overvalued. And then finally, we get to the tax benefits of share repurchases, which I mentioned briefly before, but we'll go into more depth now. So first of all, repurchases used to be taxed at the capital gains rate, of course, and you only pay on the amount of the capital gain. In other words, if you bought the shares for $25 and they got repurchased for $30, you would only pay taxes on that $5. And you would pay it at the capital gains rate, which historically has been lower than dividends, because dividends were taxed as regular income. But oh, Dr. Haggard, now you say dividends and capital gains are taxed identically. That's correct. But there's still a benefit to the share repurchase, and that is the timing option. If I don't want to receive the money now, I don't have to pay taxes now. I can put my taxes off until later. In fact, we have what's called the death option, which eliminates all taxes on capital gains. So, for example, my father was recently upset because his shares in a company were purchased from him at a premium as a result of a merger. He was very upset. And I said, Dad, why would you be upset? Even after taxes, these people have still done you a big favor. And he said, no. And he couldn't quite explain what was going on. And then it occurred to me, he was never planning to sell those shares anyway. He was hoping to pass those shares to me and my sister, at which point they would be revalued as of the stock price on the day he dies. And so we would not have to pay capital gains tax on what the capital gain that happened between the time that those people bought the shares from him and the time that he would have passed away, which he hasn't. He's still with us, thank goodness. So let's talk about personal taxes, issuance costs, and dividends. To get to the result that dividend policy is irrelevant, we need three assumptions. Number one, no taxes. Is that a good assumption? Absolutely not. We know there are taxes in the real world. Number two, no transactions costs. And one of the reasons that we need to have no transactions costs is because the homemade dividend requires you to sell stock. And when you sell stock, you typically have had to pay a transactions cost. Now, in the past, stock commissions were quite high. As of recently, pretty much anybody will let you buy or sell for free, commission free. But there still is the cost of the bid-ask spread. And so we still have not totally eliminated transactions costs. And finally, we need to totally lack uncertainty. And we know that the world that we live in is an uncertain world, so we can also discount that assumption. In the United States, capital gains and dividends are both taxed at a maximum rate of 20% as of 2019. In fact, you can pay lower rates on those depending on your marginal tax rate for your income taxes. So since capital gains can be deferred, the tax rate on your dividends is greater than the effective rate on capital gains because I can push that out further into the future. So let's talk about a firm that doesn't have sufficient cash. What could they do in order to be able to raise the cash to pay dividends? Well, in a world without taxes or transactions costs, they could issue new stock to pay the dividends that are desired by the investors. And so it wouldn't make any difference at all in a world with no transactions costs and no taxes. It wouldn't make any difference to the stockholders. However, we do have transactions costs. When we issue stock, we have to use a bunch of folks called investment bankers. And investment bankers are well-paid individuals. And so we have to pay something called the flotation cost. And so that's money leaving the firm. So there's one problem so far. And then when we pay the dividends to the shareholders, they don't get the entire amount of the dividend because they have to pay a portion to the government. And so we have these two leakages of value that tell us it is not a good idea for firms to issue stock in order to pay a dividend. So what if you do have sufficient cash to pay a dividend? If you've got a firm that has $1 million in cash after selecting all positive NPV projects, we would call that a firm with $1 million in free cash flows. And so they could consider the following alternatives to a dividend. These are things they might do instead. First of all, they might select additional capital budgeting projects, and so by assumption, these have to have negative NPV. And as an astute finance scholar yourself, you know that we do not accept negative NPV projects unless we're forced to by the government for safety or environmental concerns or similar regulatory issues. And so that's a bad idea, but we still see managers doing this because of something called the agency problem. The agency problem says that managers will spend their money, and it's not their money, it's the shareholders' money. The managers will spend shareholders' money differently than they would spend their own. And so if they could use the shareholders' money to expand the firm, even if it destroyed some shareholder value, they might do so for the honor and prestige of having a larger company. That might also lead them to acquire other companies. Now we see that by and large, acquisitions have non-positive gains. In other words, if I take the gain to the target and the gain to the bidder and add them together, it is seldom zero or positive. In other words, we are usually destroying value with these. But even assuming that it is a good acquisition, we still have high transactions costs and all the difficulties of knitting together two companies. And so you might not want your managers doing that with the shareholders' money. They could also purchase financial assets with that cash. However, why would we want them to purchase financial assets with the cash when they could send us that money and we could purchase financial assets? There are two reasons that we might want that. Number one, if they could get a higher return from such assets than we could, or number two, if they had a lower tax rate, then we might be okay with that. But by and large, those things just aren't true. And finally, we could use the excess money to repurchase the shares of the firm. I would recommend to you that the two best ways to go about getting rid of this extra cash is through dividends or repurchases. These other things typically lead to trouble. So let's talk about taxes, issuance costs, and dividends. In the presence of personal taxes, a firm should not issue stock to pay a dividend. Remember the picture we showed the government getting part of that money. So managers have an incentive to seek alternative uses for funds to reduce dividends. Personal taxes might lead you to think that we shouldn't pay dividends. Those taxes are not sufficient to lead firms to eliminate all dividend. In fact, we know that dividends are substantial and growing. Under the current tax law, shareholders generally should prefer a repurchase to a dividend because of the lower effective tax rate due to the ability to delay payment of that tax until a later date. So why do we still see such high dividends? Well, first of all, there's the desire for current income. Remember my dad? My dad likes getting those checks in the mail because he's retired. That's how he pays for the things that he needs, is with his dividends. At least the things he needs above and beyond Social Security and the pension that he receives. This has been the argument for years. But as transactions costs have come down, the idea of homemade dividends actually starts to make more sense. Yet we still see high dividend payment. And so there have to be other things going on here. we can look to behavioral finance for some answers, potential answers. First of all, it forces investors to be disciplined. If you're doing homemade dividends and your idea is to sell 3% of your portfolio every year, you might decide, oh, why not just do 4% this year and we'll go on a nice vacation. Well, now you'll have less money in the next year. When you sell 3% of that portfolio, you'll have less money. And so you could find yourself running out of money before you die. Is this consistent with human behavior? Absolutely. My wife and I used to weigh 40 or more pounds apiece more. And one of the ways that we were able to lose weight was by not keeping anything in the house that we could snack on. If we wanted a snack, we would only buy enough for one serving and no more. Because if you order a whole cake and you have it sitting in the corner, I guarantee you are going to eat it. It will not go bad on your pantry shelf. You will eat it. And so that's a similar idea here. We've got this whole cake of a portfolio. I know we're only supposed to eat 2% of it a year, but this year let's eat 5%. You know, we only live once. And so that's the first argument. Now, the second, or the question that goes along with that is, do investors have sufficient discipline to optimize their position? And the fact that we see dividends being as high as they are says no. So investors are rightly putting themselves in a position where they don't have to exercise discipline. By only spending the dividend checks they receive, they are able to prevent themselves from eating themselves out of the future. And then there is the information content and dividend signaling. So we're sending information through our dividend behavior as a firm. We see that stock prices actually increase after dividend increase announcements. From a perspective of the balance sheet, this should not be the case. Then why would it be? Well, it turns out that dividend increases are a signal that the firm is expecting to do well. Remember earlier that we discussed how dividends are sticky and how managers are reluctant to raise dividends unless they know that the permanent earnings cash flow is going to be there to support those dividends. And so if a firm increases its dividend, it's a signal that the firm's managers are expecting greater future cash flows. And do the firm's managers have more information than the standard investor? Absolutely. They better. They're the managers of the firm. They better know more what's going on with the firm than we do. So it's that expectation of good outcomes, good times, or the information content effect that raises the price on dividend increases, not the increase of the dividend itself. So here's the idea. If dividends increase, this is a sign that future earnings are going to be higher. And so that is what leads to the increase in stock price. Now let's talk about the clientele effect. So clienteles for different payout policies exist. I'll give you examples. First of all, you've heard about my dad. My dad loves dividends. In fact, that's one of the things we talk about every time we talk on the phone. He tells me about this great new stock that he's got with great dividends. Now, I'm not really all that interested. Why? Because I don't need that money to fund my current consumption because I have a good job. And so I would rather have capital gains. And so what I would want is something with 0 to low payout because I'm in my earning years and I have a higher tax bracket and I have no need to consume at present. My dad is retired. He is therefore in a lower tax bracket and he also has consumption to fund, so he's going to favor a low to medium payout. In fact, let's be frank and say that my dad would enjoy a medium to high payout. And then there are tax-free institutions. Tax-free institutions don't bear any taxes on these dividends, and so they're also going to be wanting to have medium to high payout, as are corporations. Corporations are able to exclude 50% of the dividends they receive from their taxable income. As a result, they would be twice as likely to be interested in dividends as an individual at the same tax rate. So once these clientele though have been satisfied, a corporation is unlikely to be able to create value by changing its dividend policy. So let's think this through. What if people preferred shares that pay dividends, and only 20% of the stocks out there pay dividends? As people flock to those stocks, the values of those stocks will go up compared to the non-dividend paying shares. Well, what does that mean? It means that some of these non-dividend paying firms will start to pay dividends so they can receive that higher valuation. But the more firms we have paying dividends, the more of that need that we've satisfied. And so at some point, there is no additional reward for changing from being a non-dividend paying firm to being a dividend paying firm. And so we will reach an equilibrium, and it won't pay anything to change from one form to the other at the margin. So what do we know and what don't we know about dividends? Well, we do know they're large in the aggregate. What does that mean? It means when I look across all stocks and I add all the dividends together, they're pretty substantial. We do know that the number of companies that pay dividends has declined over time. I should say the number of listed companies, because many of these newly listed firms are less likely to pay dividends. Now, why might that be? Number one, these are probably newer firms and they probably still have substantial growth opportunities. And so their free cash flow is likely to be low. They're better off to reinvest their earnings back into the firm. We also know that tax policies matter, but they don't appear to be a major deterrent. In fact, when you look at the way dividends have behaved, they don't seem to respond all that much to changes in the tax policy. We do know that corporations smooth dividends. Now, what does that mean? If they didn't smooth dividends, they would maintain a constant dividend payout ratio, always paying out the same percentage of the earnings. But what we see is that they do not do that. Instead, when earnings are down, they tend not to drop their dividends, and when earnings are up, they tend not to raise them, unless they see that the new level of earnings is likely to be permanent, in which case they are willing to change their dividend. And so this smoothness goes somewhat along with the idea of stickiness. We do know that dividends provide information to the market. When a firm raises its dividend, we see they get a nice little bump in the stock price. And when a firm cuts its dividend, we see what we call an asymmetric response. Let's assume that if you raise your dividend by 10%, that you get a 1% bump in your stock price, but if you lower your dividend by 10%, your share price might drop by 5%. That's an asymmetric response to changes in dividends. So they are providing information to the market, and firms are getting punished if they cut their dividends. Firms should follow a sensible dividend policy. So first of all, don't forgo positive NPV projects just to pay a dividend. We know that goes against the goal of financial management, which is to maximize shareholder wealth. We should also avoid issuing stock to pay dividends for two reasons. Number one, the transactions cost when we issue stock, and number two, the taxes our shareholders have to pay on those dividends. We should always be able to consider, or we should consider, share repurchases when there are few better uses for the cash. And always remember, managers, the cash does not belong to you. It belongs to the shareholders. So let's pull everything together here. First of all, we know that aggregate payouts are massive and have increased over time. But these days, they are concentrated under a small number of large, mature firms. We also know that managers are reluctant to cut dividends. That has to do with that asymmetric response that they receive from the market. We know that managers smooth dividends, meaning that the dividends don't always flow with the changes in earnings. We know that stock prices react to unanticipated changes in dividends, and that the size of stock repurchases tends to vary with transitory earnings. What does transitory mean? It means that this is an earning that we are receiving that we do not expect to continue in the future. And so it's temporary. It's not going to be a permanent expectation of higher cash flows for the firm, and so it's called a transitory earning, and it's better for us to handle that through a stock repurchase, because if we raise the dividend, we would have to cut it, and then the market would punish us for that behavior. So what are the characteristics of a sensible payout policy? Well, first of all, pay out all free cash flows over time. Now, be careful here. What if we see that we're entering into a potentially financially fraught time period? Think of the housing crisis. Think of the COVID crisis. These are two examples of times when firms might find it good to kind of hoard cash because it might become difficult to get your hands on cash if everything goes terribly wrong. So that's why we say that you should pay out all free cash flows over time. We should also avoid passing up positive NPV projects to pay dividends or repurchase shares because we know that goes against the goal of financial management. We should wait to initiate dividends until our cash flow is substantial, our free cash flow, because we do not want to have to cut those dividends. So we want to set our current regular dividends consistent with a long-run target payout ratio. So just like we see with capital structure where they have a target capital structure, here we have a target payout ratio. Let's say it's 20%. Are we going to be able to maintain that 20%? Well, sometimes when earnings dip just a little bit, our payout ratio might have to go above that. And then when we have extra earnings, it might go below that. But on average, we are shooting at that 20% target. We need to set the dividend low enough to avoid expensive external financing in the future. Remember that when we go out and get debt, it's always external and we always have to pay transactions costs to get it. But with equity, there are two ways to raise equity. We can either save our earnings and not pay them out as dividends, that's called internal equity, or we can issue new shares. Using internal equity keeps us from transactions costs, but issuing new shares means that we have to pay these flotation costs to fat cat investment bankers. And we know we should use purchases to pay out temporary cash flow increases. It doesn't make any sense to raise the dividend because of temporary free cash flow, because we would just have to turn around and cut it later and the market would punish us asymmetrically. So let's talk about stock dividends. This is a pretty worthless topic, but it's out there and it's in the real world and people still do it, and so I'm going to talk about it. This is where you get paid in additional shares of stock instead of in cash. It increases the number of shares outstanding but reduces the price. And when you multiply your new shares outstanding by the new price, voila! You get exactly what you would have gotten by the old shares outstanding by the old stock price. In other words, this accomplishes nothing. We talk about small stock dividends being less than 20 to 25% and large stock dividends being more than 20 to 25%. Apparently, there is some discretion in that 20 to 25% range. And we see in the generally accepted accounting principles, managers have discretion to name these things differently. It doesn't sound important right now whether we're calling something small or something large, but we're going to see that it impacts the way that we account for these things on the balance sheet. So we have a stock dividend here, and you own 100 shares with $50 each, and the company declares a 10% stock dividend. So this would be a small stock dividend because it's less than 20%. We know that for sure. Your total wealth before the stock dividend is 100 times 50 or 5,000. So you're going to receive an additional 10 shares. And so you'll have 110 shares now. However, the stock price is going to now fall by $5 or $4.55. So that's 50 divided by 1.10 tells us the new stock price is $45.45. If we take, and by the way, this slide should say 110 times 45.45, that's going to equal 5,000. So 110 times 45.45 is equal to 5,000, just the same as before. So the bottom line is that these stock dividends do not affect shareholder wealth. So as I said before, they're kind of worthless. Now let's talk about stock splits. They're essentially the same as a stock dividend, except it's expressed as a ratio. So for example, a 2-for-1 stock split has the same impact as a 100% stock dividend. It increases the number of shares outstanding but reduces the share price. In fact, in recent years, we've seen Apple and Tesla split their stocks. So let's do a stock split example. You own 100 shares worth $50 each, and the company declares a 2-for-1 stock split. Your total wealth beforehand is 100 times 50 is 5,000. The total number of shares you own afterwards is 200. But we know each of those shares will be worth half as much, so they're worth $25 per share. So our total wealth after the split is 200 times 25, or 5,000. In other words, this does not affect shareholder wealth. Now, typically, you hear some arguments for doing stock splits. And they, of course, would apply somewhat to stock dividends. And the big one you hear is to get the stock into a more reasonable trading range. Let's say that Apple stock was selling for $1,000 per share. There might be people out there with $500 that would like to invest in Apple, but they can't until they get $1,000 together. By having a 4-for-1 stock split, Apple's share price would now be $250. And not only could the person who wanted $500 worth of Apple be able to purchase the shares, but someone who only had $250 would be. Anytime you have a bigger audience for financial instruments, we say they are more liquid. Liquidity is the ability to sell something at or near the full market value quickly. And so liquidity has a benefit. People are willing to pay more for liquid shares than for illiquid shares. This is one of the reasons that it doesn't make any sense that Warren Buffett over the years, for many, many years, refused to split the shares of Berkshire Hathaway. And in fact, we still see that there's one class of shares that have never split. There's another class of shares now that are making that investment available to a wider audience. But still, it's a big issue that Warren didn't, I think they're called the A shares, that he's never split. So there are arguments for stock splits and stock dividends, but do not expect them to increase your shareholder wealth. Now let's talk about reverse stock splits. This is where it increases the price per share and reduces the number of shares outstanding. So you own 100 shares with $5 each, and the company declares a 1-for-5 stock split. We can calculate your wealth before the split as 100 times $5. And so the total shares you own after the first split would be 1/5 of what you started out with, or 20 shares. However, the price is 5 times as high, or $25. And so your total wealth, and it should say after a stock split, is 500, the same as before. In other words, these stock splits, reverse stock splits, don't affect your shareholder wealth. So why would people do them? Well, it moves the price to a respectable trading range. You may hear people refer to some stocks as penny stocks because they trade for a very low price. And in fact, penny stocks are great grounds for scam artists to do pump and dump schemes. If you want to watch a movie on how to get rich illegally using penny stocks, watch The Wolf of Wall Street. But don't emulate this man's activities unless you also want to go to prison. Okay, it also improves the liquidity and marketability after the split. Now, typically we think of raising the price as reducing liquidity, but some dealers might now be willing to make a market in these stocks where previously, when they were penny stocks, they would not. And so that might make it easier to buy and sell if you have more dealers being willing to make a market in those stocks. We also know that stock exchanges have a minimum price requirement, and if you fall below that, typically $1, then your stock gets delisted, and then your stock becomes hugely illiquid because your shareholders can't buy or sell. And the transaction cost to shareholders may be reduced after a reverse stock split. Think of the bid-ask spread. The bid-ask spread at minimum is 1 cent. A 1 cent bid-ask spread on a $1 stock is 1%, but a 1 cent bid-ask on a $5 stock is only 0.2%.